Jamie Dimon just issued a stark warning, a 30% chance of a major market collapse. The Fed is flipping their script, and record anxiety is spilling out of boardrooms, from Lehman Brothers flashbacks to fraud allegations that could shake property values. We're going to cover a lot more in this video, so stay tuned. Welcome back to StockScope Live. Today, we're going to unpack a wave of new warnings from JP Morgan CEO laying out a dramatic correction scenario, Federal Reserve's sudden policy shift, and AI-driven risk indicators that are flashing red. We're going to draw some parallels to historical banking crises and the dangers of current deregulation. We're also going to cover some articles that you're going to want to know about, especially regarding China-US trade war. Don't forget to subscribe and hit the notification bell. Let's get right into it.
Far more worried about that than others. So if you said, I'm talking about probabilities, I would give it a higher probability than I think is probably priced in the market and by others. Yeah. So if the market's pricing in 10%, I would say it's more like 30.
And I'm not saying one-third chance of a correction.
Yeah, I'm not saying next year. Because the timing of these things is almost impossible to figure out.
So it could be what, 6 months? Could be a year?
Could be 6 months, could be 2 years. The amount of uncertainty, and I put geopolitics in that category, fiscal spend in that category, politics in that category, the remilitarization of the world in that category, all these things cause a lot of issues that we don't know how they're going to sort out. So I say the level of uncertainty should be higher in most people's minds than...
Let's start with Jamie Dimon. There is a 30% chance of substantial market correction driven by soaring valuations in tech and AI sectors. Investor euphoria reminiscent of the dot-com bubble. And Dimon suggests that widespread overconfidence could trigger a sharp downturn. Let's open with Jamie Dimon. He said, and quote, 30% chance of substantial market correction driven by soaring valuations in tech and AI sectors, unquote. In this scenario, we're talking about investor euphoria, and its reminiscence of the dot-com bubble. Dimon suggested that widespread overconfidence could trigger a sharp downturn. It's essential to watch for the signs of crowded trades and mood swings in these high-growth areas, especially as volatility increases. He goes on to say in this article talking about gold that he's not a gold buyer because it costs money to own it. He also talked about it could also easily go to 5,000 or 10,000 environments like this. And he says this is one of few times in his life that it might be semi-rational to actually own gold. He also says asset prices are kind of high. And in the back of my mind, that cuts across almost everything at this point. So he's not saying that AI is the only thing that's overvalued. He's saying a lot of things are overvalued in the current market. He also made a couple of comments that I found hilarious. In this article, he talks about the cockroaches fear, and he's referring to banks that are not doing things the right way. He says, when you see one cockroach, there are probably more. And that I suspect when there's a downturn, you'll see higher than normal downturn types of credit losses in certain categories. He's referring to banks and lenders. Dimon and other bank leaders offered warnings about potential troubles with lending or signs of economic weakness, despite their banks posting revenue that beat analyst estimates. Now, for those of you who don't know, JP Morgan, the bank, JP Morgan Chase, is the only bank that came out unscathed from the 2008 GFC. And that should tell you a lot about how JP Morgan positions themselves in the market. And they don't care for those other lenders that go around the laws and not enforce those laws that were put in after the GFC. It's not that there isn't laws to protect investors and lenders and people who are taking loans. It's that those lenders are refusing to enforce those laws, and auditors aren't doing their job. And we're seeing the same thing that happened back in 2008. Loose lending policies are going to drive this entire thing into the ground. Now, let's move over to what Goldman Sachs said. And this is in the banking industry. Goldman Sachs Group told staffers to expect an additional round of job cuts this year as the bank sees further savings across its businesses and takes advantage of the opportunities presented by artificial intelligence. The firm said it would constrain headcount growth through the end of the year and is planning a limited reduction in roles across the firm. But still, it expects to finish the year with an increase in overall headcount. Top executives touted efficiency gains by AI as a path to more growth, saying it would be a multi-year effort to implement AI in areas such as client onboarding and regulatory reporting. Which leads me to another point, which is the AI efficiency. Now, you might say to yourself, why aren't we seeing AI efficiency show up in the balance sheets yet? Well, most companies that are doing, let's say, $100 worth of revenue today, as a very simple example. If you're doing $100 worth of revenue today and you have 2 employees, that means that each employee is doing 50. And then you add AI into the mix, and now you can do 100 with just 1 employee. Just because you added AI doesn't mean that you suddenly have double the revenue. It means that you can reduce your costs and net profits will increase. So most companies aren't focused about driving more business using AI in this stage of AI development. They're more focused about efficiency, about how do they reduce their costs to service the same level of clients. If you are a lawyer and you wanted to draft some sort of legal files, like let's say a property or fund or let's say a trust, if you have 10 clients and you bring in AI and you start going to ChatGPT and you say, hey, draft this whole trust document for me, and then suddenly you're proofreading it, it doesn't mean that tomorrow you're going to have 10 clients or 20 clients or 30 clients. It just means that you're going to be able to service those clients much more efficiently. And if every other lawyer is doing the same thing and then spending the money on more advertisements, then there's going to be the same level of competition. But typically, if you were the first mover where you're providing efficiency and then you started advertising first, you might have gained some clients. And then you can increase your headcount again because now you can double the amount of clients with the same level of employees. Similarly, in IT industry and other industries, people are cutting out headcount, but not adding more clients. They're just going for efficiency. Maybe as you get this efficiency in place, you can then scale your business easier because then you can add 25% clients and not have to hire the same amount of people to cover those clients. So that's what Goldman Sachs is doing as well. Now let's move over to the Fed flip and the yield outlook. So Powell said that the government or the Federal Reserve is going to stop shrinking its balance sheets in the coming months to preserve liquidity in the overnight funding market. He also indicated the labor markets are worsening and they need to support expectations for investors for another interest rate cut this month. Powell also argued that paying interest on reserves is a key tool that allows the central bank to implement monetary policy, and it's working well. So what they want to do is they want to stop taking money out of the system. They want to turn off the vacuum cleaner, as some would say. So some people refer to the money printer during QE, and then they set the vacuum on the environment so they can suck some of that money back out. So they're going to turn off the vacuum cleaner, but not necessarily add more money into the system. Not just yet. So they're signaling at rate cuts, and they're going to wait until they see how the effects of that happen. And we may see another rate cut before the end of 2025. And then at that point, they're going to make their decision on how to move forward. But as far as I can tell, we're not talking about doing QE just yet. In this article, it talks about the Treasury yield falling to the lowest level in weeks after the Federal Reserve Chair comments left intact expectation of 2 more interest rate cuts by the end of the year, because they want to reduce the end side of the curve. So especially on the 10 to 25 year curve. And they want to support employment over inflation control. They're saying that inflation right now is mainly not in actual inflation, but it's in tariffs. So they're not worried about it. So while bullish in the short term, this action raises deeper concerns about the underlying labor and liquidity risks that the Fed sees. So key point here is that the Fed turned dovish and it means lower yields. So they want to try to help solve the problem, but I saw another article today that said that the Fed, agreed that they're too late, and usually that's the case. Usually the federal policy is a reflection of the economy. So a lot of people say, "Oh, the Fed's acting too late," but the Fed is just making changes to reflect the current environment. They are not the environment, if that makes sense. Let's turn to the next 9th largest bank in the U.S. in the making. Fifth and Third and Comerica are doing a $10.9 billion merger, and it's presented as a sign of strength. Now, I think it's a mask for underlying instability at Comerica because they haven't been doing well. Because an estimated 600 out of 4,700 U.S. banks are functionally insolvent, pointing to widespread fragility eerily similar to the Washington Mutual and Wauchova collapses before 2008. Mergers are often the last resort, not a vote of confidence. And they're not paying them in cash, they're paying them in stocks. Now, there's also another study that the Federal Reserve Bank of St. Louis did about sentiment in corporate offices. And now what they've done is they've deployed AI to scan conference call transcripts and look for risk-related sentences. Their study spans from transcripts from 2008 to 2025, and they found record high corporate mentions of trade, macroeconomics, and financial risks, surpassing even 2008 and pandemic peaks. This suggests that companies are far more worried about systemic threats than most retail investors. Another key point that most people aren't listening to is the deregulation bailouts from the Treasury, because the Treasury is considering rolling back the Dodd-Frank regulation, which is paving the way for hidden bailouts. The problem isn't bad policy, it's non-enforcement. Ignoring banking laws like Basel III, lax oversight fuels the next round of moral hazard where institutions are emboldened by the expectation they'll get rescued. This makes the system more unstable and less trustworthy. Let's turn our attention over to Trump. So Trump is threatening China by stopping trade in cooking oil as a retaliation against Beijing for its refusal to buy American soybeans. Because if you didn't know, the American farmers are getting a $14 billion bailout. So let's keep that in mind in these contexts. Trump posted on social media that U.S. can easily produce cooking oil itself and doesn't need to purchase it from China. The comments re-escalated the conflict, obviously, causing benchmarks to turn negative yesterday towards the end of the day, and came as farmers have been suffering from low crops prices while China has been avoiding U.S. soybeans. They've been buying it from Brazil, and we mentioned that previously. It's not new news. So what happens? Well, China puts fees on American ships. America puts fees on Chinese ships. Today we saw a very a weird one where it's about there's oil tankers diverting from Chinese ports because of these new fees that they're going to be getting. As you can see here, two very large crude carriers, which can haul as much as 2 million barrels, are signaling Ningbo, port near Shanghai as their destination, according to ship tracking data. So we're seeing this escalate slowly as we get closer to the meeting that's anticipated between the two presidents. Next, I want to talk about the systemic moral hazard and legal accountability. Widespread fraud in school and appraisal districts, from overvalued bonds to equity stripping from property owners. Law enforcement's reluctance to address these crimes exacerbate the crisis, reinforcing systemic corruption and undermining faith in the financial institutions. Our takeaway here is we need reform, enforcement, and transparency are urgently required. So how can you safeguard yourself? Well, first, make sure that you diversify to preserve your purchasing power. And make sure you reach out to your representatives, whether on the state level or on the federal level, and demand more accountability. Because the only way we're going to make it out of this globally, as the US and China are going to drag the rest of us into a global financial crisis we've never experienced before. Thanks for tuning in. Leave your thoughts in the comments about, are we heading for a crash, or is this another false alarm? Hit the like and share the video, and subscribe for more in-depth analysis. Stay informed, stay vigilant, stay diversified, and I'll catch you in the next video.